Hello traders, and welcome to NOFT's Weekly Market Compass, where we help you navigate the week ahead. Our Weekly Market Compass is brought to you by our head trader Troy, who in between assisting traders in taking the next step in their careers, provides weekly and daily guidance in our live trading room every single day. Before we get into this week's guidance, we need to remind you that trading does carry significant risk, and all information in this video is just provided for educational purposes only and is not an offer or recommendation to trade future stocks, options, or Forex. From everyone here at NOFT, good hunting out there and happy trading. Here's Troy.
For Monday, February 12th, today, we really have a very, very light news cycle. You can see here that we don't have any red items for today at all. And even the medium impact are fairly limited. And it's mostly people speaking, central bankers speaking. So nothing really to talk about on Monday. And I think that part of this is due to the Olympics. The Olympics sort of taking main stage from a macro vision. There's just everybody's eyes are on the Olympics, and they're really not on what's going on in Gaza or what's going on in Saudi Arabia or North Korea, for that matter, actually. So North Korea has really softened its rhetoric based around the Olympics. So it's pretty quiet out there. So I expect today to be a fairly quiet day. That being said, obviously we've got we haven't seen this kind of volatility in a very, very long time. So I don't think that we need news events to actually create volatility, since we already have it. Looking ahead to Tuesday, we do have a British CPI, UK CPI number coming out at 4:30 in the morning. That will affect the euro as well as the pound. So I want to watch for that Tuesday morning early. Otherwise, Tuesday is very, very quiet. Another very quiet day from the news front. Again, hopefully some of this volatility will start settling down, and we'll start looking back to somewhat normal levels. 9 o'clock, New Zealand dollar inflation expectations, the only red event on Tuesday. Not a big fan of the New Zealand dollar. It's a little bit thin. I would, if you're going to trade some of those currency future contracts, I would stick to what I consider the four majors, which is the 6A, the Aussie dollar, 6B, the British pound, the 6E, the euro, and the 6J, the yen. Those are the main currency futures contracts that I would recommend trading due to volume. We look for further out to Valentine's Day. Of course, in the U.S., this is a big holiday. I read somewhere that $19 billion will be spent this year for Valentine's Day stuff, mostly candy and flowers. Yeah, it's just one of those holidays that's strictly wrapped around commercialism, consumerism. Yes, absolutely. So anyhow, but we do have some red items on the docket for the U.S. We have CPI, core CPI, retail sales, and core retail sales. All of those will be big news to what the underlying economy is actually doing. 8:30 on Wednesday. Definitely want to be paying attention. Then, of course, we have the normal news events on Wednesday, which is the crude oil inventories. This is a weekly number. Always affects the CL and crude oil prices. Lately, we've been seeing anywhere from 15 to 25 tick pops on the crude oil, but that doesn't mean it can't go more than that, just as a basic average. And then later in the evening, we have a couple red events from the Aussies: employment change and unemployment rate. Those are some big numbers for the 6A. If you're trading the 6A, you'll want to pay attention to that. You'll be some good trading in the evening on Wednesday evening after that, after 7:30, as those numbers come in. For you guys who like to trade in the evenings, the 6A and the 6J are usually pretty good trading vehicles, as well as the euro in after hours. Thursday, we really have a limited amount of information coming out on Thursday, but there's stuff I like. PPI is the only red item. I like the Empire State Manufacturing Index and the Philly Fed Manufacturing Index, as well as U.S. unemployment claims. I like these numbers. These are low impact, I should say medium impact. But I like these because both the Empire State as well as the Philly Fed gives me an idea of what that whole northeastern quadrant of the United States is doing from a manufacturing basis. Again, that's a very high cost region, and so these numbers, these guys will start, things will start turning over or in first. Whereas some of the manufacturing that happens in the southern and western states will not be impacted so much because this is a high cost labor area. It's sort of the place where you're going to see the differential when manufacturing starts hurting a little bit. You'll see cutbacks in the Empire and Philly sooner than you will in the overall manufacturing from a nationwide perspective. So I like looking at that. Capacity utilization rate. Again, this is something that macroeconomic economists look at. I like to know that when we hit about 85% is when you consider you are at full capacity. We're at 78 is what's expected. Previous was 77.9. We're starting to get into the 80% range here. At 80% rate, that's when you're going to see new factories being built, new offices expanding, that sort of thing, because they've maxed out their capacity. And this is also where you see like a third shift. At some factories will start a third shift because they are maxing out on the usage of their physical assets. And so this is a good thing. We see this go up. We'll see big commitments in construction, bigger factories expanding, that sort of thing, once the capacity utilization rate rises in the 80 to 85% area. So kind of interesting number. Again, it's something I pay attention to. Again, some of these things are not going to be big market movers, but they definitely contribute to the overall macro view of what's going on in the economy. So I do pay attention to some of these. Also, later in the day, we get some New Zealand and Aussie dollar numbers coming out. Again, these will affect the New Zealand dollar, 6N, just say 6N, the 6A, as well as the Royal Bank of Australia Governor Lowe speaks. Sort of similar to our Federal Reserve Chairman speaking. So those will affect the 6A and the 6N. Friday, pretty light day. The big one on Friday is building permits. And you've heard me talk about this before. Construction in the U.S., particularly residential and apartment, which is considered commercial, but the building permits are the first beginning telltale sign that construction is about to get ramped up. And of course, construction nowadays, it literally affects the entire economy from start to finish. So remember that when you get ready to build a house, you have local impacts, as in they hire local labor. There's it affects the counties. The counties have to expand the water system, the sewer system, the street system. So there's lots and lots of stuff that comes from building, not only on a local basis, but then you have lumber. You have all the different components from all different parts of the United States. Everything from carpet, flooring, lumber. It affects iron because of nails. It's so wide ranging. This is a very, very important. Housing starts is not so much important, and I've explained this before. The building permits have gotten to be a form of tax revenue for local governments, and we've seen building permit costs skyrocket over the last few years. There are some places in California where to get a permit you have to shell out 15 grand just to get a permit. And so there's a lot less speculative building that happens now because the cost is so much higher. Most builders are waiting until they have a pre-sale. They're not doing as many spec homes because the permits are so expensive. So When you see a number here, whatever this number is, they're not going to waste that money. They're going to start that house. So that makes the building permits more important than the housing starts. Housing starts become something that's completely related on weather. And it used to be that you could buy a permit and then you may start the house, you may not start the house. So that's not the case anymore. If you buy a permit, you're going to build that house. Then at 10 o'clock in the morning, we had the preliminary University of Michigan consumer sentiment and inflation expectations. Again, because consumers control over 70% of the U.S. economy, the sentiment of the consumer is extraordinarily important. If all of us simultaneously decide, I'm not so sure about the economy, I'm put an extra $200 in the bank just in case. Well, when you do that on a massive, massive scale, it can really, really affect the economy. And so consumer sentiment is extraordinarily important. I believe this should actually be a red item, not a medium impact item. But that being said, so that's the week at a quick little glance here. Let's jump over and take a look at a couple of charts. Let's take a look at the crude oil. Okay, so let's expand this out a little bit. Crude oil has done exactly what we have been saying it would do for literally weeks. We broke out above the 59 level back over here in December. We had this little run up, and now we have returned back to the 59 area. Now it did bounce off. If I can scrunch this down, you'll see why, because there's a substantial amount of support here, and a substantial amount of volume inside of this support. We came right down into it here and then bounced. I do expect this bounce to be short-lived, and we will continue to chop sideways, probably using this support as a little, in the short run, a little 58 to 59 area. We're going to just sort of go sideways is what I would sort of expect it to do, with a bias to the downside. As you know, this run up from October has been geopolitical based, not based on supply and demand. There is plenty of oil available. In fact, I believe this big sell-off right here was the report that U.S. production had increased 3%. Very small percentage increase, but look at the impact that had. The U.S. is actually projected to be the world's largest oil producer by 2019. So there is not going to be, and we will be a large net export from an oil perspective. So the shifting tides in oil right now, at least for the next 10 years, with the fracking, the U.S. is going to be producing well more than what we actually consume for the first time in a very long time. And of course, this is going to put pressure upon oil. So I see oil going down, bouncing around this 58, 50. You can see this 56 to 58 area here is a large amount of volume, and that will be support. Probably for a while we'll chop around, and then I still think we're going to come back and test this other area down here where we've had prior support around 53 to 49 and a half. This little area down here is another big volume area of support. We'll see how that pans out. As for a fear and greed index, we like to look at oil for fear and greed. And I would say that this has just been, this run-up has been North Korea, et cetera, et cetera. Now that those things have sort of alleviated themselves, also during this run-up, we had Saudi Arabia going through this sort of internal witch hunt. They call it a corruption purge, where there's been a big change in the power structure in Saudi Arabia to the new prince that is sort of taken over. This is all those issues coming together. Now it's sort of stabilizing, and I would continue to be on the short side of crude oil. As this fear comes out of the market, there's just the supply and demand kicks back in, and we get prices that react to supply and demand versus the geopolitical stuff that's going on. And gold looks a very similar chart. Again, we're starting to see, as some of this is dollar weakness as well, and it's same with the crude dollar weakness. But dollar is somewhat stabilized. Hopefully, it will stabilize further, and I hope it starts to form a base here where we can start building some value. But gold comes right back down into this little high volume area, but we have some decent support around 1300. I really do believe we're going to come back down and test that 1300 level at some point here in the future, because again, the fear is sort of being sucked out of the market as the dollar is strengthening as well. The ZN has done exactly what we expected it to do. You see this big downtrend. This is don't fight the Fed. This is the Fed raising rates. When the Fed raises rates, or when rates go up, bond prices go down. Here was the last week and a half of the craziness in the stock market. The bonds became somewhat of a safety play, and that's why you see prices going up. But as that fear once again is sucked out, it's not completely out, but we're certainly seeing the bonds returning back to their normal trend. I totally expect this to continue to be sideways to down, with the occasional, if there's an occasional bump in this, would be related to the stock market, and any price rise would be for a flight to safety, at which point I would be a net seller at any of these points if it can retest these, mainly because the Federal Reserve has not, if anything, they are projecting more interest rates hikes over this year as well as in the future. So that, this is a big don't fight the Fed, and sell any big pops for whatever reason would be to sell those, because in the long run the Fed will win.